Module 6. Building a blue chip portfolio. When it comes to building a blue chip portfolio, there are different approaches to consider. Here are 3 common strategies. Diversified portfolio of individual stocks. One approach is to construct a diversified portfolio of individual blue chip stocks. This involves selecting a mix of established companies from various sectors and industries. Conduct thorough research on each company, including their financials, competitive advantages, and growth prospects. By carefully selecting individual stocks, you have the flexibility to tailor your portfolio to your specific investment goals and risk tolerance. However, managing a portfolio of individual stocks requires ongoing monitoring and research to stay informed about each company's performance. Blue chip exchange-traded funds, ETFs. Investing in blue chip ETFs is another popular approach. ETFs are investment funds that trade on stock exchanges and aim to replicate the performance of a specific index or sector. Blue chip ETFs typically include a basket of well-established, large-cap stocks. By investing in a blue chip ETF, you gain exposure to a diversified portfolio of blue chip stocks in a single investment. This approach provides instant diversification and saves time on researching and monitoring individual stocks. Additionally, ETFs generally have lower expense ratios compared to actively managed mutual funds. Blue chip mutual funds. Investing in blue chip mutual funds is another option. Mutual funds pool money from multiple investors to invest in a diversified portfolio of securities, including blue chip stocks. Blue chip mutual funds are typically managed by professional fund managers who select and manage the portfolio on behalf of the investors. Investing in mutual funds allows you to delegate the stock selection and monitoring tasks to experienced professionals. However, mutual funds may have higher expense ratios compared to ETFs, and their performance is subject to the fund manager's decisions. When deciding which approach to take, consider your investment goals, risk tolerance, time available for research and monitoring, and preference for active or passive investment management. It's worth noting that a combination of these approaches can also be utilized. For example, you can allocate a portion of your portfolio to individual blue chip stocks for more customization and invest the rest in blue chip ETFs or mutual funds for diversification and professional management. Regardless of the approach you choose, it's important to conduct thorough research, assess the historical performance and fees associated with the investments, and regularly review your portfolio to ensure it remains aligned with your investment objectives. Consider consulting with a financial advisor to determine the most suitable approach based on your individual circumstances and preferences. Asset allocation is a crucial aspect of portfolio management. It involves dividing your investment capital across different asset classes, such as stocks, bonds, cash, and alternative investments, to achieve a balance between risk and potential return. Balancing blue chip stocks with other investment types is essential for several reasons. Risk management. Blue chip stocks, while generally considered less risky than smaller stocks, still carry market and company-specific risks. By diversifying your portfolio across different asset classes, you reduce the concentration risk of being heavily exposed to a single type of investment. If one asset class experiences a decline, other asset classes may help mitigate the overall impact on your portfolio. Balancing blue chip stocks with other assets provides a cushion against volatility and helps manage risk. Return optimization. Different asset classes have varying levels of risk and potential returns. While blue chip stocks have the potential for capital appreciation and dividends, other asset classes like bonds or real estate investment trusts, REITs, may offer more stable income streams or potential capital preservation. By incorporating a mix of asset classes, you can optimize your portfolio's return potential based on your investment goals and risk tolerance. Income generation. Blue chip stocks are often known for their dividend payments. However, by diversifying into other asset classes, you can enhance the income generation potential of your portfolio. Bonds, for example, provide regular interest payments, while real estate investments can offer rental income. Balancing blue chip stocks with income-generating assets can help create a more consistent cash flow stream and provide a buffer during market downturns. Capital preservation. While blue chip stocks can offer long-term growth potential, they can also experience significant price fluctuations. By allocating a portion of your portfolio to assets with lower volatility, such as bonds or cash, you can prioritize capital preservation. These assets can act as a hedge during market downturns and provide stability to your overall portfolio. Time horizon and goals. Your investment time horizon and goals also play a role in asset allocation. If you have a longer time horizon, you may be more willing to allocate a higher percentage of your portfolio to blue-chip stocks, which have historically demonstrated growth over the long term. However, if you have a shorter time horizon or specific short-term financial goals, a more balanced allocation between blue-chip stocks and other assets may be appropriate to reduce risk and provide liquidity. It's important to periodically review and rebalance your portfolio to ensure it remains aligned with your investment objectives and risk tolerance. Changes in market conditions or your personal circumstances may warrant adjustments to your asset allocation. Consulting with a financial advisor can provide valuable insights and help you determine the optimal asset allocation strategy based on your individual needs and goals. Learn how to manage and adjust your portfolio over time based on changing market conditions and personal financial goals.